Today we'll teach you an effective way to execute a trend analysis on gold. You will learn how to accurately identify the market trend. We will discuss minor, midterm and long-term trends, and I will explain their interconnections. Take notes and let's get started. And let's start with a short but important theory. There are multiple ways to identify the market trend on gold. One of the most efficient ones is based on price action analysis. When we do price action trading, we perceive price movements on gold chart as a sequence of impulse and retracement legs. A bullish impulse leg is a strong bullish movement up. A retracement will be a correctional bearish movement within that impulse. A bearish impulse leg is a strong down movement. A retracement will be a bullish correctional movement within that impulse. Trade gold and forex with a trusted broker. Get 100% first deposit bonus. Just use the link in the description below. So the retracement is strictly shorter than the impulse leg preceding that, and it should strictly complete within the range of the impulse. That is how this reasoning works in practice. Impulse legs are strong directional movements and retracements are the movements within the impulses. In price action analysis, the positioning of impulse and retracement legs will be used for the identification of the market trend. A bullish impulse, a retracement, and the second bullish impulse with the completion above the high of the first bullish impulse will confirm an uptrend. The highs of these impulses will be called higher highs. The low of the retracement between them will be called a higher low. A bullish trend will be violated if the price violates the level of the last higher low. For that reason, it will always be a critical point in uptrend. That's the example of a bullish price action on gold. You can see that over time gold keeps setting higher highs and higher lows. According to the rules, the market trend is bullish and it will remain bullish till the price is trading above the level of the last higher low. When the price violates that, a bullish trend will be violated. The opposite logic will be used in a bearish trend. A bearish impulse, a retracement, and the second bearish impulse with the completion below the low of the first impulse will confirm a downtrend. The lows of these impulses will be called lower lows. The high of the retracement between them will be called a lower high. A bearish trend will be violated if the price violates the level of the last lower high. For that reason, it will always be a critical point in a downtrend. And that's the example of a bearish price action on gold. We can see that over time the price keeps updating lower lows and lower highs. That confirms that gold is trading in a downtrend, and the trend will remain bearish till the price is trading below the level of the last lower high. When the price violates that, a bearish trend will be violated. Depending on the scale and the price duration of the impulse legs that you analyze, the market trend can be different. Ignoring minor price movements and paying attention to more significant waves may completely change the perspective. And here I will need to introduce you to the notions of minor, midterm, and long-term trends. Minor trend is the trend that is based on the smallest recognizable impulse legs. Long-term trend will be based on the biggest recognizable impulse legs, and midterm trend is simply in between, ignoring minor movements and longest waves. This model will help you to understand how midterm, long-term, and short-term trends are interconnected. As you can see, the long-term trend on the left represents the most significant impulses, and as you can see, midterm and short-term trends occur within the range of the last bearish impulse in our long-term trend. And the short-term trend occurs within the range of the last bullish impulse in a midterm trend. Let me show you a real example. And remember that the same rules and the same logic for the market trend analysis will be used on any time frame. Look at my price action analysis on gold on a daily time frame. What I did, I identified the smallest recognizable impulse lags. This impulse lags will define a minor trend on gold. But if we zoom out the chart, the perspective will be different. As you can see, a minor bullish trend that we spotted is occurring within the range of this strong bearish impulse. From a midterm perspective, gold is bearish, and we can see a strong bearish impulse, a retracement with the formation of lower high, and another strong bearish impulse with the new lower low. So our minor bullish trend is simply a correctional movement within a midterm bearish trend. And what about the long-term trend? When we analyze a long-term trend, we are trying to identify the most significant waves. As you can see, the long-term trend is bullish, and midterm and short-term trends that we spotted are occurring within the range of the last major bullish wave in a long-term trend. And here's how a complete trend analysis on gold should look like. The market is trading in a long-term bullish trend. After the price set the last higher high in a bullish trend, the market started a correctional movement and the market established a midterm bearish trend. After the price set the last lower low in a midterm bearish trend, the market started to trade in a minor bullish trend. That is how simple yet telling this price action analysis is. Market trend identification is the most important step in gold analysis. This price action method is very simple to grasp, yet it is very efficient and accurate. Use that for day trading, swing trading, or scalping gold. Let me know your in the comment section if you have any questions. Trade gold and forex with a trusted broker. The link in the description below. Also, traders, please watch my other videos.